What's up, everybody? Today, we are going to be talking about a few very high dividend paying stocks. We have a couple fairly well-known businesses we're going to take a look at. I'm going to give you my opinions on them. And then at the end, we also have one stock that is also a high dividend payer that I have been buying more of. It isn't as well known, but if you've been following the channel, then you might have an idea which company that is. Now, first, before we get into it, I just want to talk about dividends in general. I do like when companies I own are returning capital to shareholders. However, I think for a number of investors, sometimes people focus on dividends too much. Choosing to pay out a dividend is a capital allocation decision. Sometimes that may be the best decision, sometimes it might not be. If a company is growing and can get better returns reinvesting their capital into their own business, then they should probably do that. I usually don't emphasize dividends. I emphasize risk reward, profitability, free cash flow. Ultimately, a dividend has to be paid out from the actual cash that a company makes. If a company does not have strong free cash flow, but they have a very high dividend and they're funding that dividend partly by maybe taking on more debt to pay out their dividend, then that's a red flag. That's not value. That's not a deep value investment. Just having a high dividend does not make a stock great. Sometimes people conflate dividend with value or high dividend yield with deep value, and they are not the same thing. To me, deep value is about incredible risk reward. It is often a company with a very cheap valuation. Sometimes if it's a high quality growing company, we can relax that valuation requirement a bit. Either way, no matter what, with any company, we're going to have to make assumptions about the future and see what does the risk reward look like. There are plenty of stocks that I think are deep value that do not pay a dividend at all. And there are plenty of companies that pay a very high dividend that I think are not value. Now, with all that said, I understand for some investors, when you see a high dividend yield, that is like a red flag to a bull. So we're going to take a look at some of these companies today. As always, if you get value out of the video, subscribe to the channel. If you want to make spreadsheets like this or just support what I do, consider following me on Patreon. Link to that is down below. Now, let's get into it. And the first stock we are going to look at today is one I'm sure many investors are familiar with. It is UPS. Good old United Parcel Service. This company is more than 100 years old and very simple business to understand. They deliver packages all over, not just the US, but also internationally. It's true, the US makes up about 2/3 of their revenue. It really did surge quite a bit during COVID. We see just on their revenue chart here, bam, 2020, 2021. In fact, revenue right now is down from where it was 4 years ago. And we really see the stock is quite a bit down. Over the past year, UPS is down 36%, even over 5 years, down 50%. UPS is roughly trading for the same price it was trading at, almost 20 years ago. But it's got that big, fat, juicy dividend yield, 7.5% dividend, trading for, roughly 12, 13 times earnings. So we're going to see, is this stock value? Now, just taking a glance through their most recent earnings here, we see revenue down a bit over the past year, operating margin down a bit. Now, there are some trade headwinds from tariffs that do have an impact on their international business to some extent. But even in the US domestic package market, it wasn't really that strong for them. Now, some good things about this business first. UPS is kind of like an oligopoly. I mean, you have UPS, you have FedEx, you have USPS, but there aren't that many players that have the scale to have the delivery network that UPS has. This makes their cost per package pretty low. I mean, we see that in their operating margins. Their operating margins being right around 10%. Pretty decent, not too bad for a company that just moves things from point A to point B. You could argue that there's a little bit of a tailwind as there's still some room for e-commerce to penetrate more of total commerce. But maybe a few headwinds as well. Amazon used to be their biggest client, at least by revenue. Now they're having a little bit of a mini breakup, not a total breakup. Amazon is still a client, but they're diversifying a bit with FedEx. UPS is saying, Amazon shipments weren't really all that profitable in the first place. They're focusing on higher profitability, trying to improve their margins. But let me show you why I recommend you don't just blindly look at dividends. This is their cash flow right here. They say, okay, $2.7 billion year to date from operations. Once you subtract out their CapEx thus far, about $2 billion, you're down to not even $1 billion in free cash flow. Now, so far this year, they have spent out $2.7 billion in dividends. They've also repurchased $1 billion in shares. They are spending billions of dollars here that they don't have. So where is this money coming from? Well, if we go over to their cash flow statement, we see, look here, debt issued. They have issued $2 billion more in debt than they have paid back. They're taking on debt to fund a dividend. And to me, I look at this situation and I don't think it's sustainable. A dividend of over $5 billion a year for a company when I look at their adjusted free cash flow, and they're lucky if they're hitting $5.5 billion. And I don't think they want to use all that money to go and pay out their dividend. So I wouldn't be surprised if UPS cuts their dividend. If they do, I wouldn't be surprised if the stock drops further. So I don't recommend that anyone invest based on looking at 7.5% dividend right here. Rather, look at this number, 4.8% adjusted free cash flow yield. Roughly 5% adjusted free cash flow yield. Remember, I always adjust by subtracting out share-based compensation. That is a real expense to us. This is the money that the company is really making, the cash that the underlying business is producing. Ultimately, when I think about what we could expect for a return on our investment today in UPS, I'm looking at a company that I don't really expect to grow much on the top line over the next 5 years. Maybe low single digits, but I'm going to put in no growth. Operating margin, I think 9-10% is fair. Maybe they get back to 10%. Adjusted free cash flow margin, the money that I think can come back to us shareholders, I'm giving them 5%. That's $4.5 billion coming back to us shareholders every year. And then as far as a multiple that we could give this company 5 years from now, I mean, a company with no growth on the top line at all, a 10 times multiple, I'm really hard pressed to give them more than a 10 times multiple. And with these assumptions, you're looking at a 6% annualized return on UPS. I mean, even if we make this multiple 11, 8%, you need to get like a 12 times multiple, or you need to get some extra growth or margin or something before you're getting a 10% annualized return on this stock. So to me, is UPS deep value? No, it's not. Is UPS even value? I'm not sure. I don't think it's the worst investment in the world. Not here to trash on the stock, but it's not for me. I don't think I'm being offered enough of a reward here. We could put in a bear and bull case, but honestly, at this point, I just don't think the reward is there. Just looking at my base case numbers, I know this stock is not going to be for me. Now, maybe if they cut their dividend and the stock price crashes, but really nothing has changed about the underlying business as far as the free cash flow that they're producing, then yeah, maybe at some price, I would be interested at UPS, but it would be a lot cheaper than it is today. And I know the price is down 50% over the past 5 years, but it's still not a buy for me. Just my opinion. And that brings us to the next company we're going to talk about, which is TROW price. The numbers look quite interesting here, trading for a multiple, maybe a little over 10 times earnings. They pay a pretty sizable 5% dividend, and they are buying back stock, so they're returning a ton of capital to shareholders. Operating margin looks very high. Return on invested capital looks great. Revenue looks like it's been up and to the right. So it seems like this company is checking a lot of the boxes. But I have some concerns, and to start with, if you're not familiar with TROW price, this is a pretty large investment company. They manage a lot of retirement accounts. Some people might have their IRA or Roth IRA at TROW price, or maybe your company has a 401k plan and is managed by TROW price. And all that money that they manage, that is referred to as AUM, assets under management. They charge their clients fees to manage this money. And the average rate that they are getting here every year is their effective fee rate. And that's right now about 40 basis points. So that is 0.4% of assets under management every year. Now, considering we are in a 15 or 16 year bull market where pretty much everything has just been going up, that means that even if their underlying business is doing nothing special, simply because the market is going up, their assets under management is going to expand. And that's what we see here. You know, they start this chart very nicely at 2010. I think we know what might have happened in 2008, 2009. Clearly, assets under management have been increasing over the past 15 years, but you see what happens in a drawdown. Look at what happened from 2021 to 2022. Assets under management down, about 25%. So while this graph looks really nice, while the revenue of this company, the revenue growth looks really nice, it has really been fueled by the market. In fact, if we look over the past 5 years, the net flows, this is just money coming into their accounts or money coming out. It is negative. People are pulling their money out of TROW price. We haven't seen assets under management declining really, simply because we've just been in such a good market. If a bear market comes, or even if we just have a lost decade where stocks, kind of go up or down, but we pretty much have a sideways market for 5, 10 years, whatever, I don't think that this business is going to perform nearly as well. I mean, look at these net flows. Retail investors in particular, that is the orange down here, they have been pulling out a significant amount of money. And to be honest, I expect this to continue. TROW price, their fees are quite high. 40 basis points is not cheap. If you just want to invest in the S&P 500 or something like that, you can pay just a couple of basis points to Vanguard and they'll invest you in an S&P 500 index. If you want to invest in something else, there are just tons of funds that are cheaper than this. As markets have opened up, the world's just become more connected. Fees have been coming down over time. I mean, they don't show you a graph here like this one for fees over the past 15 years, but if they did, it would be a downward sloping line. And to be honest, I would expect that to continue. You have many low-cost alternatives. TROW is also a brokerage, but that's not really where their revenue is coming from nowadays. I mean, as a brokerage, you can't really charge fees on stock commissions anymore. There's just so many zero commission brokerages out there like Robinhood, eToro, all these up-and-coming little brokerages. When I look at TROW price, I see a company that is underperforming, but it is hidden by the fact that we have a bull market. Outflows are significantly negative for retail clients, and for institutional clients, it's better, but still not amazing. I don't like the trend. While margins look great, they have been coming down. This company used to be, close to 50% margins, then down to 40, low 40s, and now we're into the low 30s for operating margin. And yes, that's still a fairly high number, but they overhired post-COVID. Their operating expenses, I think, have gotten a little bit bloated, and I just don't have a lot of conviction in the underlying business. So as far as what we can expect for a return on our investment, if we invest in TROW price today, I mean, revenue growth over the next 5 years, this is very hard to predict. It's going to be heavily dependent on the market. If this incredible bull run continues, this could be, high single digits, but for my base case, I really can't give them anything higher than 4%. Certainly in a bear case, this could get ugly. Remember what happened in 2022 to this company. Assets under management down about 25%, revenue down 15%. Operating margin and free cash flow margin, I'm going to hold it close to where they are now. I think I'm actually being a bit optimistic here. They're going to be under pressure on the margin front. I think their fees are just going to be coming down over time, and that puts pressure on margins. And as far as what multiple we can expect for a company like this, just giving them a multiple of 10, which I think is fair. It's close to what they're trading for now. You're looking at a 9% annualized return on this stock today. Now, that might seem reasonable, and if this were a certainty, if you could lock in a 9% annualized return on a stock, I'm sure tons of people would do that in a heartbeat. But the fact is, I don't think I was conservative with my numbers here. It certainly could get way uglier, and this isn't enough of a reward. Just to give you a sense, if we truly had a bear market and revenues are down, 5% every year for 5 years, operating margins become under more pressure and they compress down to maybe 27%. Free cash flow margin, I'm going to have to bring that down too. And then if I give this company an 8 times multiple in operating income, in fact, they've been closer to 6 to 7 times multiple many times in the past. But if we just give them an 8, then, you're down 20% on your money after holding this stock for 5 years. I think there's a pretty significant amount of risk here. Even though it looks cheap to me, this is not deep value. I think TROW is an example of a company that looks like a quality business. It looks like it checks all the boxes. It really looks like it should be a value investment, possibly a deep value company. But looking under the hood, it's just not for me. It's going to be a pass. And that brings me to the final stock we're going to talk about. I know I've mentioned it before on this channel, but I am adding to this company. It is, in my opinion, deep value. Again, just my opinion. This is not a recommendation to buy this stock. This is another company with an ugly looking chart. Oh, by the way, I realized we never looked at TROW's price chart. In case you're curious, TROW down more than 50% from their peak, even over the past 5 years, down 30%. Now, as far as Nomad Foods here, it's been a pretty ugly year, down 30%. Over the past 5 years, down 50%. So yeah, it doesn't look pretty. We started looking at this stock when it was maybe about $17.50 a share. We looked at it again when it was 15. When it was at 13 and change almost a month ago, I said, I'm entering a position here. And yes, now that it's 12 and change, I'm adding. We won't do a deep dive. I don't want to bore regular viewers who have heard this before, but they are the market leader in European frozen food. Yes, a very niche market, very boring, slow growing business, but we see, revenue growth, it's been consistent. Operating margins been incredibly steady, pretty much right at 12% for a decade now. They're returning a ton of capital to shareholders. They have a 5.5% dividend, and they are buying back an absolutely massive amount of stock. So total shareholder returns here, very high. Yes, there are red flags here, like their debt, which is reasonably high. Their longtime CEO is stepping down. Again, I'll put a link to another video where I talk more about the company, but just to show you why this is different, in my opinion, than UPS, than TROW price, look at the assumptions I made. I'm assuming 3% revenue growth on the top line. This is basically just the top line growing in line with inflation. assumption. You know what? I'm actually going to change this to 0%. We're assuming the company is stagnant for 5 years, but they retain their margins. Operating margins been very steady. They retained those 12% margins. Free cash flow margins been also quite steady. And if I give this boring company just a 9 times multiple, which I think is fair, I think it's reasonable for a business like this, you are looking at a 19% annualized return over 5 years. That is more than a double. Total return, dividends and all, you would be up about 140% over this time. That is the reward, at least in our base case. I mean, you could imagine that the market might re-rate this to, 12 times multiple, and they might have a little growth on the top line. And just to look at what that case would look at, if we give them, maybe 4% growth on the top line, we'll keep the margins the same, and we'll just give them a 12 times multiple. You are looking at a 34% annualized return on this stock. So reward, definitely there. As far as our bear case, I think 0% revenue growth is actually fair in the bear case here. Operating margins, they've actually never dipped down to 11%, but even if we pull it back to 11% and cut that free cash flow margin back significantly to 8 and only give them an 8 times multiple, you are still looking at a respectable return on this investment today. 7% annualized return on Nomad Foods. This is a company that I think is just too cheap. And this is an example of a high dividend stock that, yes, I think is deep value. Again, that's just my opinion. So if you got value out of this video, subscribe to the channel. If you agree or disagree with anything I said here, leave that down in a comment below. And I hope to see you all in another video.